and welcome to Trade Finance Talks TV. I'm your host, Dipesh Patel, editor at TFG, and we're coming to you live from It for Cyprus, a conference where the trade finance industry is being hotly discussed. When you boil down the evolving dynamics within trade finance, they all attempt to tackle uncertainty and insecurity. With this in mind, the role of credit insurance companies are even more important in the trade finance space, and I'm really lucky to have the opportunity to have the brains of two experts within the field, Marcus Miller and Marie-Aude Vesval from Marsh. They're very well positioned to anticipate some of the changes, the challenges facing the credit insurance market, and also responding to the trade finance dynamics. Marcus, Marie-Aude, welcome to Trade Finance Talks TV.
Thank you for having us.
Thank you. So Marcus, quick introduction to you first. Who are you, where are you from, and what do you do?
So both Marie-Aude and I work for the Marsh McLennan Group. We work within Marsh, one of the operating companies, or the largest operating companies, and we work in our global credit specialties business. And within that business, we're organised by industry group. And the industry group I look after is on behalf of financial institutions called the Lenders Solutions Group. And that also includes more recently the non-banking financial institutions as well. And within that group, we have a number of regional leads and a number of product leads.
Thank you very much. And Marie-Aude?
So I'm one of the product leaders in the Lenders Solutions Group led by Marcus, and I'm dedicated to developing risk participation solutions for our bank clients, and my scope is global, so I work with all the regions.
Thank you very much. Both very, very big remits within the group. So I'll start off with a big question, and Marcus, over to you. Let's take a step back. Can you perhaps outline some of the key mega trends, the big trends that we've seen within the trade finance and the trade credit space over the last, say, 1 to 3 years?
I think, as ever, ever evolving regulation continues to drive the agenda with respect to lenders, particularly, and what they can do for their borrowers. And by that, I think we're all aware of Basel III and some of the proposals there and the impact on banks' lending portfolios going forwards. So that doesn't go away, and as that changes, we see that banks are repositioning their portfolios to be efficient and to deliver what the borrowers are looking for in a way, but also a way to maintain profitability, which is what we're all looking for. But alongside that, and this is why we're big trade finance fans, is that again over the last few years we've seen a real trend in repositioning lending books into shorter dated trade finance assets, and certainly from a credit insurance perspective, credit insurers were getting quite full on longer dated assets and some of the more structured transactions like pre-export finance and project finance, and there's definitely a move back now to shorter dated assets and secured assets and assets that have great performance history, and certainly credit to the ICC as well, who've worked hard over recent years to position trade finance as a high performing asset class with low default rates, which really lends itself to us being able to risk transfer effectively into a willing investor base.
Yeah, thank you. Good summary there. And I think the OECD forecasts that global trade and services is set to grow by around 2.3% this year and 3.3% next year, which is almost double what we saw 1% growth in 2023. How do you think, Marcus, that this projection is going to impact some of those trends in the industry going forward?
Well, I think certainly pre-COVID, trade finance was growing or outgrowing typically GDP in many countries, but post-COVID there was definitely a retraction or a slowdown going forward, and I think the Russia-Ukraine has been very disruptive. Situation has been very disruptive to supply chains, and you look at agriculture and commodities within that within the particular sector-specific areas, and high interest rate and global inflation have definitely had an impact or had an effect. But I feel like we're sort of moving out of the dip post-COVID and moving forwards again for the reasons I outlined originally. I think in the context of trade finance, good performance history, and supporting the real economy in the context of recovery, which is still ongoing.
Thank you. And I guess you touched upon the rise of trade finance as an asset class earlier. Can you perhaps elaborate on the move that banks are shifting towards that slightly harder originate to distribute strategies? What are the reasons behind this, and how does that change the role of insurers in this game?
Yeah, it's a great question, and I think it's that move from a buy to hold, particularly with some of the larger institutions who are originating assets and sitting on them and taking yield on those assets, and they had a big book. And again, regulation has a big part to play in this, as portfolios are being remeasured in the context of the impact of regulation on capital charges going forwards. There's really a view that having the ability to sort of dynamically manage that portfolio through a risk sharing, risk distribution serves a number of purposes. One is that it keeps the portfolio dynamic, which makes it more resilient in the wake of financial shocks as well. And secondly, I think it helps manage the capital, the capital provisioning, because you can move assets in and out according to where the portfolio sits. So I think we feel that distribution model can, and of course also it can have a positive impact on profitability, because as you originate assets, there's a feel element to that you don't have, and if you have the right type of risk sharing partners, you can kind of move between those dynamics and look to maintain and create a profitable book going forward, again in the wake of what is perceived to be quite penal regulation.
Thank you very much, Marcus. So can you talk about how credit insurers are responding to that changing originate to distribute model?
Yeah, so I think what banks are looking for, again, with a real originate to distribute or originate to share model, is looking for reducing execution risk, certainty of appetite and pricing. So, and often some of these structures are having a resurgence. They're not necessarily brand new, but having committed capacity and pre-agreed eligibility criteria. So a syndication department or a portfolio manager can instantly distribute risk with willing investors. And I think the credit insurance market, particularly for shorter dated assets, is now very good at providing that instant response versus the typical 2, 3, 4 day turnaround time where we're canvassing a number of different insurers for different pricing and appetite. Creating a portfolio solution gives scalability, and it's super efficient. And again, it plays very well to an originate to distribute model where you can immediately and instantly distribute risk.
Yeah, thank you very much. And I guess on that distribution of risk, I'm going to come to you, Marie-Aude. Can you tell me a little bit about Master Risk Participation Agreements, MRPAs as they're commonly known, that legal agreement executed between the lender and a participant, and what's the role of MRPA guarantees in the distribution of those trade finance assets?
Yeah, so MRPAs are initially a bank-to-bank product that is used by banks to share trade assets between them on a funded or unfunded basis.
Yeah.
And by extension, insurers can also issue MRPAs as an alternative to credit insurance. So they would have the same effect. Both MRPAs and credit insurance would cover non-payment of the bank's client. It's just a different form of cover and different terms and conditions. So MRPAs, they have benefits against non-payment insurance. They are basically on-demand guarantees. So sureties would pay a lot quicker when there is a demand from the bank. There is less conditionality. And in terms of remuneration provisions, information sharing, administration of underlying transactions, there is a better alignment between the bank and the participant under MRPAs. In the insurance market, we could use MRPAs as an alternative to credit insurance for every underlying asset in theory, but in practice, there are two bigger applications of MRPAs with insurers. One of them is FI programs, and the other is guarantees, performance guarantees. So for FI programs, MRPAs are very good for banks because when they have very large programs that they distribute to many different parties, they can align the way they distribute between multilaterals, banks, insurers. They would have the same form of cover of all of them. And for guarantees, it's also a very good match because the MRPAs would mirror the bank's own obligations when there is a draw under an SBLC. For guarantees, MRPAs are placed into the surety market rather than credit insurance market. Allow the sureties that issue these MRPAs to cover exactly the same underlying obligations they would be covering if they were issuing a direct surety bond.
Mm-hmm. And how do MRPA guarantees impact regulatory treatment? So
credit insurance and MRPAs would have the same treatment.
Yep.
So they would get this. They would give the same capital relief to banks. They are treated the same. What's interesting from a regulatory point of view is that guarantees are an asset that is already very efficient from a capital consumption point of view. The reason being that they are off-balance sheet assets. And so there is a credit conversion factor that applies to the nominal amount of the guarantees to calculate the exposure at default that is taken into account in the calculation of the RWA. And at the moment, a very critical discussion that is happening is around the increase of the credit conversion factor for performance guarantees from 20% to 50%, which is what was recommended under Basel IV. In some jurisdictions, there has been some pushback, and so it's going to stay at 20%, and in other jurisdictions, it's still pending. And in some jurisdictions, the 50% CCF is already applying. So that's creating a big change in the market, because that will banks will have a lot more guarantees to distribute, and we're going to see growing demand for sure for guarantees going forward.
Thank you very much. And I guess in relation to that, what are some of the current demand and supply issues in credit insurance markets, and how would you say these issues are affecting trade finance?
So for guarantees, interestingly, that's a trade asset that is not very widely distributed. Mm-hmm. One of the main reasons is what I've just mentioned, the capital efficiency of guarantees. Which means that banks don't get a lot of capital relief by distributing the guarantees. Mm-hmm. And if they don't get a lot of capital relief, the reason why they will distribute these guarantees is credit relief. So when they have peak exposures on some corporates, that's when they tend to distribute. And the sureties, they tend to also be exposed a lot to these same corporate names, because they issue direct bonds to these same corporates. And so you get capacity constraints. When banks come to the market with these names, sureties are already quite exposed. They don't necessarily find the capacity they need to distribute into the surety market. And in addition to this, there is a little imbalance between the risk appetite of the sureties mm-hmm. and their pricing expectations. So for all these reasons, banks don't distribute a lot of guarantees because it's not so efficient to bring them to the surety market. And if you don't get a lot of capital relief, you need everything else to be very efficient for it to be meaningful. So you need volumes, speed, pricing, admin to all be very efficient. And it's not necessarily always the case today. So what that means is, first, we need to find more efficient solutions. Portfolio solutions could be a way for banks to distribute higher volumes of guarantees in a more efficient way. So that could be static or dynamic portfolio, securitized portfolio, hybrid ones. There are many options that we can look at. But also the most critical point is growing the market, to bring more sureties to the table, to support banks in a less competitive way with banks. And it's the case in every region at the moment. This CCF question is creating needs in various regions around the world, not only Europe and the UK. And there is space for more sureties to join the table and to think about solutions for banks. Especially at the moment, we're looking at Asia, North America, the Middle East. That's where we need to work on the supply.
Thank you very much. So currently, we're seeing challenges around capital relief, capital constraints, and potentially the increase in distribution. But let's take a future-looking view. Marcus, what do you see as some of the future of trade finance in terms of its evolution, perhaps taking a longer 5-year view?
So I think we'll hear it all over the next few days. Is that digitalisation is a big thing and is underway one way or another in all markets, and I think the joining together of the different investor bases together with the sort of the suppliers, if you like, to make that efficient is still happening, and there's a number of intermediaries as well that to varying degrees are able to sort of help with that journey. So that I mean, and of course trade finance, because there's good performance data around it. It's relatively well commoditized in terms of types of underlying products. So again, it lends itself as a real pioneer on that journey. And then sustainability is the other one in terms of how the world of trade finance can focus on bringing the sustainability out, or sort of being able to isolate that, and a lot of that will come through regulation as the regulators are able to then measure the impact of banks' portfolios, and that will then impact the way they distribute, and that means that the suppliers need to kind of understand and be receptive to how that looks. So I think that they're the two main things that we see. I think generally from a capacity perspective in the credit insurance market is pretty well served. Mm-hmm. They could be better on appetite, as Marie-Aude described. I think we see a lot of concentration towards preferred names, but again, portfolio solutions are great because it enables us to bring in some of the lower rated names to balance off against the higher rated names in a way that when you're distributing individually isn't so successful.
Thank you very much. And Marie-Aude, what advice would you give to companies, say banks, FIs, multilaterals, etc., really looking to navigate some of these current challenges that we're seeing, both from a credit insurance and from a trade finance landscape moving forward?
So you need to choose a good broker. I think that's the most important choice. We're working with different markets. In trade finance, you could access the surety market, the non-payment insurance market, the trade credit insurance market. So these are all nuances that we can help banks navigate, and they don't need to worry about that. We're a one-stop shop. They can come in and we'll find a solution in one of these markets.
Yeah, many times we review existing programs and find that the terms are no longer competitive, and we have over 60 insurers, 60 insurers offering different types of credit-based solutions, and almost always we're able to find a more efficient and competitive solution. But it's ongoing. There needs to be regular reviews on programs and access to the full market and new capacity, which is coming in all the time.
Thank you very much. That was Marcus Miller and Marie-Aude Vesval at Marsh. Here we are at the ITFA annual meeting in Cyprus, Limassol. Thank you for joining us.
Thank you, Deepesh.